Investing is a great step towards financial growth. However, choosing the right type of investment can be confusing for a beginner. Instead of rushing in and buying a bunch of different stocks or bonds, you may want to consider buying some type of fund. A stock represents a share of ownership in a company. When a company, like Amazon or Apple, does well, those who own shares receive the benefit. As the company grows the business, the stock price usually goes up along with it, giving investors the opportunity to sell shares for more than they bought them for. Funds are a pooled investment that contains shares of many different stocks, bonds, and other assets. When you buy shares of a mutual fund, you receive a piece of everything included. Welcome to Gray Skies Media. We are here to help you invest in your future. Please do us a favor and hit that like and subscribe buttons for more content like this. Now, for you more advanced investors, we know that you can earn money through shorting stocks, using options, and etc. In this video, we're just going to explain the basic differences between mutual funds, index funds, and ETFs. Let's start with mutual funds. Mutual funds got their official start in 1924. However, variations of mutual funds started in the 1700s. Today, there are over 7,000 mutual funds. Mutual funds are intended to pool the money of many investors to create a diversified portfolio which helps offset an investor's risk. When you buy a mutual fund, you're actually buying portions of stocks, bonds, and other securities. Many financial experts liken the purchase using the stew pot analogy. When you make a stew, you combine a group of ingredients into a single pot and cook them together. Then, when you take a spoonful of stew, your spoon will be holding a small amount of each ingredient. It is important to note that unlike index funds and most ETFs, a mutual fund is actively managed by a professional portfolio manager. As the name implies, actively managed funds use an active investing strategy. This means that they frequently buy and sell investments. This typically results in higher costs or expense ratios and can be a drag on a portfolio's performance over time. Diversification is the primary benefit of buying a mutual fund. If one company that the fund invests in has a tough year, the impact on the fund's total asset can be small because that struggling company is only one fraction of the fund's total assets. Mutual funds tend to charge annual fees commonly referred to as expense ratios, plus commissions which can affect your returns. While a talented manager could earn good returns for the investor's fund, there is no guarantee of success. If a manager makes choices that don't pay off, investors won't earn the expected returns. However, even if the fund doesn't perform well, the manager still collects a fee, which is paid from fund assets, meaning even lower returns. Management fees aren't the only cost our investor has to pay either. Besides transaction fees, the fund may have a sales load, which is a charge to either buy or sell shares. Some funds also charge an additional load if shares are sold within a specific time frame. In addition, mutual funds can only be purchased once a day, typically at the end when their net asset value is set. And they have a minimum initial purchase requirement, somewhere between $100 to $3,000, although there are a few minimum ones and some with much higher minimums. So, if you're thinking about investing with a mutual fund, be sure you know how these fees impact your earnings in the long run. Now, let's discuss index funds. Index funds got their start in 1975 by John Bogle, and the first fund is now known as the Vanguard 500 Index Fund. Index funds track a market index, such as the S&P 500, thus the name index funds. Like mutual funds, index funds offer diversification as they are comprised of a combination of securities in the index they track. These funds typically use a passive investing strategy, which means their objective is to deliver returns similar to an index of investments. There are many market indices and index funds that follow them. Today, there are just north of 1,700 index funds. However, index funds usually deliver returns that are slightly lower than index due to fees associated with these funds. Simply put, index funds are built to have a similar performance to that of a major market index. Because index funds are passively managed and simply track an index, they generally have a low portfolio turnover, which means they infrequently buy and sell investments. Infrequent buying and selling typically translate into low expense ratios. The low expense ratios of index funds can possibly lead to more growth when compared to higher expense ratios of mutual funds. Like mutual funds, you can't purchase index funds on an exchange, but must go through a broker or the fund itself. Even though diversification offsets risk, there are no guarantees, and because they track an index funds are exposed to the same risks as the index they're following. For instance, if the S&P 500 declines in value, then index funds which track the S&P 500 will follow suit and decline in value. A nice benefit of both mutual and index funds is the ability to automatically invest by setting up recurring monthly deposits from your checking account. Next, we're going to discuss exchange-traded funds, or ETFs. The world's first ETF was created in Canada in 1990, transforming the investment landscape and offering the advantages of pooled investing and trading flexibility. In 1993, the first US-listed ETF launched, which was the SPDR, and it benchmarks the S&P 500 index. Similar to an index fund, ETFs can track indexes, commodities, currencies, and other assets and seek to deliver returns similar to the index that they track. Different from an index fund, ETFs offer both diversification benefits of a mutual fund, but the ease of trading of a stock. Like index funds, most ETFs are managed passively through algorithms, so you don't have to pay sales commissions to a portfolio manager. Unlike mutual funds and index funds, ETFs are traded on a stock exchange that can be bought and sold throughout the day. However, not all ETFs are widely traded, which can cause difficulty when trying to fill orders. ETFs have other attractive qualities. While most mutual funds require a minimum investment, which can be substantial, an ETF investor can just buy a single share. Also, because most ETFs are actively managed, they typically have lower management fees than mutual funds. There's a wide variety of ETFs that attempt to track assets, like corporate bonds, stocks in remote countries, commodities, and even currencies, among many other investments. While these assets carry unique risks, the ETFs that track them offer investors a practical way to analyze and potentially find opportunities in a number of markets. Remember, like index funds, ETFs have the risk of a decline in the index, commodity, or asset declines. If you like the idea of combining active management with an ETF, there's an increasing number of actively managed ETFs now on the market. But, as always, do your research on fees and track record. Any of these three options offer diversification and are easier than picking a diverse portfolio of individual stocks. Regardless of which one you pick, you'll need to do your research on each and understand their tax implications, returns, and etc. before you make them a part of your long-term financial strategy. We hope we provided you with a basic understanding of the difference between mutual funds, index funds, and ETFs. What do you think about the video? Please, let us know in the comments, and don't forget to like and subscribe. Click on that bell icon so you never miss an upload. See you in the next one.